Okay, I'm sorry for the cutting of the video. All right, so the balance of payment is actually a useful tool in explaining the movement of, in exchange rates, right? So the more the surplus we have as a country, the higher the buying power of the local currency, right? And this is also explained by the forces of demand and supply. All right, so if we have more reserves of foreign currency, it simply means that the demand for them is going to fall. So if there is low demand for foreign currency, it simply means that we are going to go for the other alternative, which is the local currency, right? So it simply means that more of the foreign currency reserves is going to trigger more of the demand for the use of the local currency. The contrary is also true. If we are having a deficit in the balance of payment, this simply means that our local currency is going to depreciate and the demand for the currency that buys more is going to be higher, that is the foreign currency. So any justification for printing more of the local currency should be supported by the existence of foreign currency reserves. Why? Because if we have got more reserves of foreign currency, it simply means that the buying power of the local currency is going to increase. Okay, and perhaps that is why in countries like Zimbabwe we are backing our currencies with gold. Okay, so gold is almost of the same equivalence with the USD currency in terms of buying power, in terms of value, right? So if we have got more of those reserves, it simply means that we will be having an appreciation in the local currency. But let me just explain further in terms of what appreciation actually mean. Okay, if exchange rates, okay, let me just give if we are saying on 1 January the exchange rate between the USD and the Zimbabwean dollar was let's say 25 ZWL per dollar. Okay, if at 1 January 2025 the exchange rate was 25 ZWL or Zim dollars, 25 Zim dollars or Zigs, 25 Zigs per $1 US. All right, and then on 25 February the exchange rate is now 20 ZWL per dollar. Sorry, don't know what's going on with my pen. Okay, that simply means that the currency, the local currency, the ZWL is appreciating, is gaining in value. All right, so do not be hoodwinked or do not be, dazzled with these with the pattern of figures. If the rate is like, if the figures are going down, it simply means the currency value, the value is appreciating, is going up. If the exchange rate is increasing, like for example, if today the rate was 40, if today the rate was 40 ZWL to $1, it simply means that we are depreciating. The currency is depreciating, right? So do not like it when the figures are increasing day after day. They should fall, right? And if they are falling, then the Reserve Bank would be justified to print more money. But if the rates are not falling, okay, if the rate is not falling between the US dollar and the local currency, it simply means that no justification for printing further of the local currencies, okay, but we need then to fight for policies that enhance the balance of payment so that by the end of the day we will be in a surplus position. If we are in a surplus position, then it also means that we have got more than enough foreign currency reserves. And if we have those reserves, it also means that our local currency is going to be demanded because it has gained value, it has gained the power to buy. Okay, I think that's enough for now. Why the balance of payment matter. Let us move on to the purchasing power parity theory. All right, so this theory stipulates that exchange rates are influenced by differences in inflation rates between countries, right? It predicts the future exchange rate movements using inflation rates. Okay, so as local prices change with inflation, exchange rates should adjust to keep the relative price constant. So the idea in having the exchange rate movement is to enable the prices of commodities or affected commodities to remain constant in purchasing power or in purchasing value terms. All right. So I've put an example there where a laptop is costing $1,000 in the US and £800 in the UK with an exchange rate of $1.25 per pound. Right? So US inflation increases by 10%. This raises the laptop's price to 1,100. All right, somebody might be asking, how was that? All right, initially it was $1,000. This laptop was $1,000, but because of the inflation, we're going to say $1,000, okay, multiplied by 1 plus R. Our R is the inflation rate, which is 10%, and 10% is 0.10. So 1 plus 0.10, it becomes 1.10. So if you punch this figure in your calculator, 1,000 multiplied by 1.10, you are going to come to $1,100. So to maintain the purchasing power parity, the exchange rate has to adjust by 10% as well, right? So originally it was 1.25. So if we say 1.25 multiplied by 1.1, we are also going to arrive at 1.375. Right, so, but what does that mean? Somebody might be wondering. Okay, so remember, the laptop is £800 in the UK. So if I have £800, all right, and I just want to use £800, all right, to buy the laptop in the UK. I don't want to carry my laptop. I will buy the same laptop in the US, right? But I've got £800. If the rate does not respond to inflation, it simply means that if I go to the UK and try to change my £800 to US, if I multiply by the original rate of 1.25, it means I'll be having how many dollars in pocket? I'll be having $1,000, right? Which means I won't like it because I won't be able to buy the laptop. So to ensure that I buy the laptop, the exchange rate has to arise in line with inflation. The exchange rate has to rise in line with inflation. So in that case, it has to increase by 10% as well to come to 1.375. So if I then use that rate, you will see that 1.375, this is going to give me 1,100, which is enough to buy a laptop. So the purchasing power parity theory keeps the laptop price equal in both countries when converted into the same currency. Are we together, ladies and gentlemen? If you convert the 800 pounds into US dollar, we are going to arrive at the price enough to buy a laptop. All right, so we have talked of predicting future exchange rates, right? Future exchange rates. So the PPT predicts that the country with the higher inflation will be subject to a depreciation of its currency. We have spoken about that, okay? Even when I was discussing the aspect of the balance of payment, where we are saying that if we are going to have these rates increasing and increasing, it simply means that our currency is depreciating, right? So higher inflation again is also an indicator of a depreciating currency. Okay, so if you need to estimate the expected future spot rates, simply apply the following formula. So this is the PPT formula. You are going to be given this formula in the examination, so do not worry, but you need to understand what it means, right? So the SO here you are seeing is the current spot rate. The S1 is the future spot rate. You can estimate this, all right? Or you can predict the spot rate that is going to come. If you have got the variable, you have got today, you have got the spot rate today, right? And then you have got the inflation rate for the foreign currency for the foreign country, okay, for the foreign country. And then this one is the local country. The inflation rate, the HB, is the inflation rate for the local country. All right. So the foreign country is the foreign country's currency is also is called the counter currency, while the local country's currency is called the base currency. Sometimes the examiner in the scenario is not going to tell you this one is the local, this one is the foreign, right? But you just have to understand that this numerator is talking of the country in which or for which the spot is quoted, all right, which is also called the base. This B, we are talking of the B, all right. The B is talking of the inflation rate in the country for which the spot is quoted, or the base currency, right? For example, if in our example of the ZIG and ZW, I talked of the ZIG as ZWL. When I said ZWL 25 per dollar, all right, I said ZWL 25 per dollar. So you need to understand which one is the base currency and which one is the counter currency. Okay, if you're looking at this rate, okay, it can as well be written as ZWL per dollar, then you get your 25 here, there. So okay, I'm sorry for the the jacks and interruptions. during the recording process, and I've discovered that most of the information has been rubbed off. I'm sorry for that, but don't worry, we are together. But what I was trying to illustrate was that you need not to worry about whether the numerator is the home currency or the foreign currency. All right, that one shouldn't be the rule to follow. You need to understand that a currency which has been quoted within the exchange rate is actually the best currency. So I have given you a rate which we can use as an example, right? Let us use the problem. My pen is sticking sometimes, right? So we talked of the rate where, don't know what's going on. Okay, my pen is sticking and misbehaving. Right, we talked of the ZWL per dollar rate. All right, where I say that sometime in January it was 25 ZWL as to $1. All right, so as you can see, this rate is simply saying that it is quoted, the rate is quoted in USD. It is quoted in USD terms. Right, so the USD becomes our best currency. Right, the USD becomes the best currency, and the counter currency is then the ZWL. Right, so in this case the ZWL is the counter currency. So you then slot in the inflation rate on top. You use the inflation rate. The H would be less. If the inflation rate for the US was 4%, you just have to say 1 plus 0.4, because that's 4%. All right. And if the inflation rate in Zimbabwe is 7%, then sorry, I'm confusing. Right, so we have said that this is quoted in USD, so obviously the inflation rate for the USD should be on the below here, and then the inflation rate for the counter currency should be on top. So if the Zimbabwe rate is 7%, you then put your 7 on top there. Sorry for that, excuse me for that. Okay, so this is the idea of, let us do an example to illustrate the point further. All right, so we're given exchange rate which is currently dollar per pound. Right, the inflation rate in the US is 5% per annum, and in the UK is 2% per annum. So you need to understand the quoting. The quoting is given as dollar per pound. So in this case, the best currency is actually this denominator. All right, the denominator it shows that the rate is being quoted in pound sterling. So the pound becomes the best currency. All right, the best currency. So we can see here that the UK, which is the best currency, has got an inflation rate of 2% per annum, whereas the counter currency, the USD, it has got an inflation rate of 5% per annum. In this case, we can safely see that if we come here, but the question wants us to forecast the exchange rate in 1 year's time and in 2 years' time, right? This is a typical exam question. So which formula are we going to use? If we are given this information, we are going to use the PPT, right? The purchasing power parity theory, all right? That's what we're going to use. So we know that the exchange rate in year one, which is our S1 from the formula, remember, the S1 is equal to the current spot rate today. The spot rate today is given here as dollar per pound 1.70, right? And we have said that the base rate inflation is the denominator, which is, we are told that it's 2%. So 1 plus 0.2, that's what you are seeing there. And this is the counter currency inflation rate, which is the USD. And we get this amount. All right. So for year 2, we're going to take this amount, the year 1's amount, and adjust it according to the rates we have established above. So it simply means that if you have mixed everything on the first stage, you are going to be wrong throughout. Okay, so that's the trick, ladies and gentlemen, and we need to be very, very vigilant. So you need to first calculate the rate for year 1, and then you take that figure, you start with the figure as your spot rate, and then you adjust. You can see that these ones are just the same. All right, they are just the same. So this is why I say that you need to just get the correct figures in their correct places at the very correct or very first time. Then you get your answer there as your spot rate in year 2. So the PP, the purchasing power parity theory helps us to forecast those future exchange rates. Right? You can as well have a look at this particular example. But let's now talk of the Fisher effect. All right. The Fisher effect is actually not part of the causes of the inflation fluctuation. I mean the exchange rate fluctuations according to our initial note. Let me just show you the initial note, because a lot of people confuse this, especially in an MCQ question. What's happening? Having a sticking keyboard. I'm trying to locate the cursor. What's happening here? Okay, so what I was trying to say was that the Fisher effect, although it's a relevant subject area, it is not part of the causes of exchange rate fluctuations. Okay, because we talked of 4 items, and the first one was the BOP, the balance of payment, and we talked of the PPPT. All right, and there is what is called interest rate parity theory, and then the 4-way equivalent. So you can see that the Fisher effect is not part of the direct causes of exchange rate fluctuations, but it's a very relevant formula in forecasting. All right, in forecasting rates or interest rates. Okay, it's very, very essential because it also plays with the 2 rates, the inflation as well as, the interest as well as the inflation rates. Right, it explains the link between the 2. So according to this theory, the actual interest rate, when we talk of actual, we are also referring to what is called the nominal or money rate. Right, the nominal or money rate. So this is the rate that includes the real interest rate. Okay, real interest rate, what the investor is really up to, or what is expecting to get out of his efforts. Right, what does he really want to get? All right, so there is the real rate of inflation as well as an inflation premium. Right, we need to also consider the inflation premium if we are looking at the actual rate of return, the actual or the actual interest rate, all right, we'll be looking at a rate that includes the inflation component, because in a real environment, or business environment, obviously, we cannot rule out inflation. There are very few countries which are operating in a very, very stable and zero rate inflation. All right, there are very few, if not none. Right, but that's a debate for another day. So there is a formula you are going to be given in the examination that talks of the Fisher effect. All right, so we are given this particular formula where 1 plus I is equal to 1 plus R multiplied by 1 plus H, and I is the actual interest rate or nominal or money rate, the rate that includes inflation. Okay, the rate that includes inflation is given by 1 plus the real rate of interest multiplied by 1 plus the inflation rate. Okay, so perhaps you want to do an investment appraisal. The examiner might not give you the discount rate to use, and you should be in a position to estimate that using this particular formula. So sometimes the examiners will be interested in, because you're not going to get as a question that says, oh no, calculate the Fisher effect or what. No, you're going to be given these formulas in the examination, but they will be hidden somewhere. The examiner is not going to tell you this time you must use the PPT, this other time you must use the Fisher effect formula. No way, it doesn't work like that. So you need to lead yourself, you need to ensure that you have done a thorough coverage of the syllabus. Now let us look at a scenario which might assist us in understanding what we are talking about right now. Okay, Growthland's economy is expanding, but there are concerns about rising prices. The real return. Investors in Growthland demand a 3% real return on their investment, meaning they want a 3% increase in purchasing power after accounting for inflation. All right, now, if we are saying after accounting inflation, here we are simply saying after excluding inflation. All right, if we exclude inflation, what we are aiming to get is the real rate of return. So the real rate of return is a rate which excludes the inflation. Okay, it excludes the inflation. Please get this point right. Right? Excluding, after excluding inflation. All right? Now, what about the inflation forecast? Economists predict inflation will be 4% over the next year, meaning the cost of goods and services will rise by 4%. Remember, the definition of inflation is the general rise in the prices of goods and services, the general rise. So we are given those, and a clever student is now in a position to compute the nominal rate of interest. The nominal rates we are given, the formula is actually the nominal interest rate. The nominal interest rate is given by the this formula 1 plus nominal rate. But now, one thing I want you to understand is we want to calculate the nominal rate. We don't know this rate, but what we know is we are given the real rate and the inflation rate. So we need to make the nominal rate subject of the formula. All right. So let's substitute the figures into the text. So first of all, because we don't have the nominal rate, so we'll ignore that, but we need to put it in the formula because by the end of the day, that's the variable we are calculating. So 1 plus nominal rate is equal to 1 plus 0.03, which is the real rate, multiplied by 1 plus 0.04. And if you solve out, if you continue to solve, you're going to get the nominal rate, which is equal to this 1.0712 minus 1. Why are we saying minus 1? Because this figure, this 1 plus, should also be eliminated until we are left with the nominal rate, because that's the figure we need to calculate. Excuse me. So we are going to get 7.12 as the nominal rate. Okay, so what's the conclusion? To compensate for the 4% expected inflation and deliver a 3% real return, lenders in growthland should set a nominal rate of approximately 7.12%. This rate will allow investors to maintain their purchasing power and achieve the desired real return. So if they do not factor in the inflation rate, they are going to suffer, right? They're not going to get whatever they are expecting. Why? Because inflation is going to erode the value of their investments. Are we together? Thank you. So it's a very important thing to consider in this regard. Now, the interest rate parity. This is now the third cause. This is the third cause of the fluctuations in exchange rates. Interest rate parity theory uses the difference in interest rates between two countries to forecast future exchange rates. You are going to be given the formula, as you can see on the screen. In the exam, this formula you are going to be given. As you can see, it is identical to the purchasing power parity. However, we have determined that the purchasing power parity theory is used to forecast the expected spot rate. But in this case, we are forecasting the forward rate. Okay? We are actually forecasting the forward exchange rate. The forward exchange rate, forward contract, all those things. All right. In reality, neither the PPP or IRP can perfectly predict exchange rates due to other influencing factors. Right? There are other influencing factors like those which we've talked about, the balance of payment, and so forth. There are so many things that happens in an economy: wars, cyclones, natural disasters, pandemics. All those affect the performance of these, or the accuracy of these theories. Okay, but in an examination, if you are asked to predict a forward exchange rate, well, some questions are not going to tell you the forward exchange rate. You can use this formula, the interest rate parity theory. Okay. Now, this is the four-way equivalence. Somebody might be having some questions. This, do we have somebody like, okay, oh, what is it? Something like that. What are those variables like? And like I said, the C and B simply mean the same. Okay, the B is actually the best the best interest rate, all right, and the I is the counter interest rate, something like that. And this one, the SO, okay, obviously the SO is the current spot, right? Current spot rate in this case is our SO, right? Just a minute, let me verify first on that. to see, let me look for the formula table. Just 1 minute, and let me show you the formula table as well. You might need it. Okay, unfortunately, our tables do not show they do not show the information which we need, right? But as you can see, we are having all the formulas we have been talking about. The Fisher formula is there, and the purchasing power parity and interest rate parity are also given there. They are not explaining the variables, but like I said, this one is the interest rate parity theory, okay, and this one is the spot rate, and this one is the interest interest in the country D, or let me just say in base country, and this one is in counter country. Something like that, counter country. All right, and it's advisable when it comes to this that you then have to determine, you'll be led by the scenario. Actually, it's going to tell you, to give you some hint, which one is the best country and which one is the something like that. So you can as well, in the interest in the interest rate parity, you can always assume that this is the local currency, or the local interest rate. The denominator is the local interest rate, and that one should be the foreign country interest rate, right? But now when it comes to this one, now it's sometimes the examiner is not going to be very predictable. All right, you might give you a scenario that doesn't talk or give you some hints on where you are, and you just have to then make use of the quotation, which according to the rate that is given, which one is the best, which one is the denominator of the rate there. That's the one you're going to put on this. Okay, ladies and gentlemen, if you're still with me this far, then I must congratulate you for your patience and your zeal to understand these things. All right, so far we've covered a lot of things. All right, the major causes, all right, the major causes of exchange rate fluctuations. We have talked of the balance of payment, the purchasing power parity theory, the interest rate parity theory. Okay, they have been explaining why we find exchange rates different or fluctuating at times, right? We also touched on the Fisher effect, right? Though not a major or a direct explanator of these movements, it has got something to say. It actually contribute to some of these nuances, right? So here we then look at the last cause of these fluctuations, that is the four-way equivalence. The four-way equivalence is a concept in international finance that links together four key theories, right, and relationships, namely the interest rate parity, purchasing power parity, the Fisher effect, and the international Fisher effect, resulting in an interconnected relationship among these factors. The important factor here, or fact, is that it ensures no arbitrage opportunities exist in international markets, which means it actually removes the possibility of information asymmetry, or maybe lack of proper information in the market. So at international level, there is actually no arbitrage opportunities. This is why maybe in in these uh, capital markets, you are not going to find somebody who is going to win millions overnight, whether it be Bitcoin trading or these other, electronic uh, financial markets platforms. The opportunity of making it is there, usually scant. It's not obvious, right? Why? Because the arbitrage opportunities are going to be as minimum as possible, right? Because of this four-way equivalence theory. Okay, so it has got four components. The first component is the interest rate parity theory, which we discussed earlier on, which tells or which talks of the difference in interest rates between two countries, which which is equal to the expected change in ex, exchange rates between the countries' currencies, meaning investors should be indifferent. They shouldn't worry, okay? They should be indifferent between investing in either of the countries, as the difference in interest rates will be offset by changes in exchange rates. That's why we talked of the laptop example, where even if inflation rates rise and so forth, the exchange rates themselves are going to as well respond in line with the changes in inflation rates and so forth. So you will see that even if we are saying the Fisher effect is not going to be applicable, it is applicable in the other way, because it talks of that relationship between inflation and interest rates. All right. So a change in interest rates is likely to, between two countries, is likely to be equal to the expected change in exchange rates between the countries' currencies, meaning investors shouldn't worry much. Okay, if inflation or if maybe um, the interest rate rise, then there is more potential that the exchange rate will also follow suit. So those movements are likely to maintain the status quo. Now, the purchasing power parity. In the long run, exchange rates should adjust to equalize the price of identical goods and services in different countries. Hence, if a country's inflation rate is higher than another's, its currency should depreciate to maintain the parity, right? So when your inflation rate rises, obviously your domestic currency is likely to fall in value. Okay, and this, by the end of the day, it is going to stabilize the parity or to maintain it. All right, but the question that comes is, how is that going to happen? If you go back to the example I gave of a laptop, where I said that at one particular time the rate was $1.25 to £1, okay, and the laptop was priced at 800 pounds in the UK. All right, but in the US, the same laptop was priced at $1,000. But with the rise in inflation in the US, the laptop was now valued at 1,100, because there had been a 10% increase in inflation. All right, so to maintain the price, the same price, okay, to maintain the same value of the 800, because at this particular point, initially, 800 pounds was equivalent to $1,000, because the rate was $1.25 per pound. So to enable the same 800 pounds to purchase the laptop, which is now $1,100, we need to then adjust the exchange rate will self adjust in line with inflation, and that's when we say that for the 800 pounds to be able to buy that laptop, we need also to increase the rate by 10%, and it becomes 1.375. So if you change the 800 pounds with at the rate of 1.375, you then have to multiply it with the amount you are going to get the 1.100. So that this is why the purchasing power parity is going to remove whatever arbitrage opportunity that exists, because if the exchange rate does not move in line with the inflation, then arbitrageurs are going to benefit, because they are going to to capitalize on that on those information asymmetries. Okay, so the four-way equivalence simply saying that in the long run, the exchange rates are going to self-adjust in line with the movement in inflation, and by the end of the day, no more arbitrage opportunities are going to exist. Now, the Fisher effect. This we have already seen that it describes the relationship between nominal interest rates and expected inflation. And that was that formula: 1 plus I is equal to 1 plus R multiplied by 1 plus H. If you still remember that, okay? And we say that it actually predicts the nominal interest rate. All right, and the nominal interest rate is that interest rate that has got both the real rate of return as well as the inflation premium. So basically the implications are that higher expected inflation in a country will lead to higher nominal interest rates. Are we together? And you will see as we move on that the features formula is also used to compute discount rates, which are useful for project appraisal. All right, bear that in mind. Then, lastly, the international Fisher effect. The IFE states that the difference in nominal interest rates between two countries is an unbiased predictor of future changes in exchange rates. Countries with higher nominal interest rates will see their currencies depreciate relative to countries with lower nominal interest rates. Okay, so what then? Okay, how then does this four-way equivalence help us to integrate and remove any arbitrage opportunities? When these four theories are combined, they form a system of interconnected relationships among exchange rates, interest rates, and inflation rates. The equivalence ensures consistency and balance in international financial markets. In summary, the four-way equivalence provides a comprehensive framework for understanding how interest rates, inflation, and exchange rates interact in a global context. So, ladies and gentlemen, it's quite magical if you understand this at first glance, but through further reading, further research online and so forth about this four-way equivalence, you understand it further. All right, so we need to move, ladies and gentlemen. Let us get to the next aspect. Now, the real business: foreign exchange risk management. There are types of risks. There are three types of risks which we need to worry in this examination. The first one is transaction risk. This is the risk that a transaction in a foreign currency at one exchange rate is settled at another because the rate has changed. Okay, so you might enter into a particular transaction today at a certain exchange rate. For example, you might sell something today at a particular exchange rate, but then when you receive the money, the exchange rate would have differed. All right. So by the end of the day, uh, you are likely to gain or to lose the value of your money. So this is the risk financial managers attempt to manage and forms most of the work they do, right? So and it also forms part of almost the major part of this topic or this lecture. All right, so usually transaction risk is normally considered important because it affects cash flows. It affects cash flows. All right, those losses or gains would be actual money. So financial managers put much of their effort in mitigating or in trying to mitigate or address the impact of this transaction risk. All right, what about translation or accounting risk? Now, somebody might be saying or might be confused and say, but how come the translation risk is called accounting risk when actually the financial managers are not usually bothered about it? The truth is they are also bothered, but in terms of cash flows, this risk is only a risk on paper, right? It's a risk in the account of the business, right? But not on the bank of the business. So you will discover that translation or accounting risk, as I've already alluded to, is only a risk that bothers accountants in their preparation of financial statements. When they try to translate the financial operations of a foreign company or foreign subsidiary, there could be some, exchange gains or losses from those translations. Okay, when you do the conversion of a foreign, let's say maybe the functional currency of the subsidiary was different from the functional currency of the parent. In that case, we are going to have some exchange gains or losses from conversions, right? But those do not affect the bank balances because they are only theoretical losses or unrealized losses and gains. Are we together? That is why they are recognized in other comprehensive income, unless if we are about to close the subsidiary, that's when they are going to be recycled into the statement of profit or loss, those gains and losses. Are we together? So they are less relevant to financial managers because they are book entries as opposed to actual cash flows. We already stated this. All right, so what about this last one, economic risk? This refers to the change in the present value of future cash flows due to unexpected movements in foreign exchange rate. For example, raw material imports increasing in cost. So this one, although it has got some transactional risk effects, it is long term. This is usually long term. Okay, in the longer term, if situations are not addressed, then we are likely to suffer some losses financially. All right. Uh, so we are looking at the present value of future cash flows being deviating from our expectations, or being deviated from our expectations owing to the movement in long-term exchange rates. All right. Thank you for that. Let's move on. Now, let's talk of the foreign exchange market. The foreign exchange market is also known as Forex. If you have been in a country that uses a lot of currencies on its day-to-day trading practices, the word Forex isn't new to you, right? Word Forex isn't new. The biggest center in the London Forex market, the biggest center is the London Forex market, although since the market is very competitive, virtually no differences exist between one Forex market and another. Usually in the world, when we talk of Forex markets, we can't leave out the London Forex market, which is considered one of the biggest markets in the world. Of course, this is debatable, right? Because in other countries, such markets are there. So this is why we are simply saying that the characteristics of these markets are almost similar. Okay, they are almost similar. Now, exchange rates. We have already discussed what exchange rates are. The exchange rate on given day are known as spot rates. So the word spot actually talks of the exchange rate. And two prices are quoted depending on whether we are buying or selling the currency. The difference is known as the spread. All right. Usually, you are going to be given something like this. All right. So we are being told that the difference between the two figures is what is called the spread. All right. Now, when you are given these rates, always know that the bank benefits. The bank has to benefit. So, in every transaction, either you are a buyer or you are a seller. All right. So, if you are selling the currency to the bank, the bank is likely to give you a rate that puts you at a disadvantage. Okay? You are likely to be given a rate that puts you at a disadvantage. So, for example, you want to sell pounds. All right? You want to sell pounds. But we are given this rating. Those are the rates. All right? You want to sell pounds, but the rate is $1.6250 per pound. So it's between $1.6250 and $1.6310 per pound. So if you are selling pounds, let's say you are selling 100 pounds, which rate do you think the bank is going to buy your pounds at? Obviously, the bank is going to buy your pounds at the higher rate. They are going to use the higher rate. Why? Because they want you to get I mean, since you are selling the pounds, the idea is you want to get the dollars. Okay, you are selling pounds, but you want to get the dollars. So obviously, in this case, sorry, in this case, you are not going to be given the higher rate. Okay, you're not going to be given the higher rate. I'm sorry for that. The bank is going to give you the lower rate. Why? Because lower rate is going to give you very, very few dollars. Right? So you want to sell your 100 pounds. So how many dollars are you going to get? The dollars you are going to get with the lower rate, we are going to say 100 multiplied by 1.6250, and you are going to get something like $162.50, right? So this is what you are going to get, $162.50. All right. Why are they doing this? Because they are in business. They want to remain in business, so they're going to give you a lower rate. All right. Okay. What about if you wanted to sell dollars? Okay? You wanted to sell dollars this time. If you wanted to sell dollars, let's say you have got $100, and we are saying the bank is the one who has to benefit. Which rate do you think they are going to give you in this case? Let's think. Are we going to use the same rate? This time, using the same, we are going to use the same rate. But now, in this case, you are selling the dollar, but you want the best currency. You want the currency that has been quoted. All right. In this time, as you can see, the rates have been given in pounds, dollar per pound. All right. So $100, for us to get the pound, we need to divide. Okay, the rate has been given with the pound as the best currency. Excuse me. Okay, so in this case, we are going to divide. So if we are going to divide, which rate is going to put us at a disadvantage? Remember, always the bank has to benefit. So in this case, if the rule is that the bank is always going to benefit, then we are going to use this time, we are going to use a rate that is higher. This time we're going to use the rate that is higher, not this one. Okay, because if we use the lower rate, when we are going to divide, then it means we are going to get more money. So to get very few pounds, we are going to use the higher rate. And if we punch the figures in the calculator, it means we are going to get 100 over 1.631. So in this case, we are going to get 61 pounds 31 pence or 31 cents. I don't know how they call them in London. Okay, but if we had used the lower rate, let us just out of interest, if we had used the lower rate, we're going to find heart rate over 1.6250, and you see that we were going to lose a lot of money. 6250. We're going to get 61.54. So you can see that we're going to get a lot of pounds, higher pounds than these ones. So this one is wrong. That's wrong. Okay, we do not do such a thing. Why? Because all the time the bank has to benefit. Are we together, ladies and gentlemen? Thank you. Now, we have got an example there which I feel you guys should use to understand. APLC receives $100,000 from a customer in the United States. The exchange rate is dollar per pound 1.6250 to 1.6310. How many pounds will A receive? And I say that if we are going to receive pounds, all right, the bank is always going to benefit. And remember, the exchange rates have been quoted in pounds. The pounds is the best rate, is the denominator there. So you can see that we are going to divide. To change these USD into pounds, we are going to divide by a higher rate, because the higher rate is the rate that is going to give us very, very few pounds. And this is why you are seeing that we have divided with the higher rate there and obtained that amount. Usually, the questions in the examination relate to real currencies such as dollars and euros. However, occasionally the examiner invents currencies, which makes the answer a little more confusing. It becomes even more important that you know the rules. And I've given you, all right, I have given you the rules and tips so far, and you just have to replay the video to understand what I meant by knowing when to divide. You need to know when to divide and when to multiply. All right? You need to know when to divide and when to multiply. If the base currency is the amount of money, if the amount of money to be received is to be converted into the base currency, therefore you need to divide. Okay, you just have to see with the the type of the rate quotation, right? Because if you do not use evidence from the quotation itself, you are going to be in trouble, right? So in this case, as you have seen, the quotation was in pound sterling. Why? Because as you can see in the wording of the exchange rate, it was given as dollar per pound. All right, and we need to convert this amount to be received into the dollar pound. Into pounds. Therefore, we need to divide. Even if it was a payment, all right. Let's say it was a payment. Even if it was a payment, we were as well going to follow the rule, okay, of the quotation. Are we together, ladies and gentlemen? So if it was a payment, let's say PLC was going to pay 100,000, okay, $100,000 to a US supplier. Okay, let's say this time they wanted to pay, so we can use the same rules. Okay, let us do that out of interest and see if we can come up with something meaningful, right? Let's say this was a payment, right? PLC pays 100,000 to a supplier. This time they are paying to a supplier in the US. Okay, the exchange rates are just as they are. So which rate do you think, okay, how many pounds will a PLC pays? So using the same rate, what rate are they going to use? Remember, we are always going to be at a disadvantage. That's the rule. That's the rule. So in this case, we need a rate that will enable us to pay more dollars. More pounds. We need to pick a rate that will ensure that we pay more pounds. So in this case, we're going to say 100,000 divided by 1.6250. Okay, and this is going to ensure that we pay as much pounds as possible. So that's 61,538. All right, this is the amount we are going to pay. Are we together, ladies and gentlemen? Always I will always tell yourself, in this game of exchange rates, I am always on a disadvantage or at a disadvantage. I will always be at a disadvantage. If it is a payment, it means I have to pay more. If it is a receipt, I have to receive less. That's the game. That's the game, ladies and gentlemen. Okay. I've already talked about this, but we can self-check ourselves to see if what we are telling one another is actually what we have written. Okay. Let me pause a bit. There's a call. Okay. Jimmy is a company based in India where the currency is the Indian rupee. They owe money to a supplier in Ruritania where the currency is Ruritanian dollars. The amount owing is 240,000. The current exchange rate is Indian rupee as to Ruritanian dollars, 8,600. 8.6380 to 9.2530. How many Indian rupees would Jimmy have to pay? All right. So the rate is quoted in Ruritanian dollars. All right, but we are talking of the rupees we are going to pay. So you can see that it is the other currencies now, not the Ruritanian dollars, that have to be paid or that have to be converted. Okay, we need to actually convert the Ruritanian dollars into rupees. Excuse me. We need to convert the Ruritanian dollars, okay, and then be able to pay we need to convert the amount owing into Indian rupees, okay, because we need to pay this guy who are in Ruritania. All right, but the rate has been quoted in Ruritanian dollars, right? So in this case, all right, in this case, the examiner wants us to come up with figures in Indian rupees, and the Indian rupees are not the best currency. In that case, if they are not the best currency, you don't divide, but you multiply. Then you tell yourself, if I am paid, I need to pay more. All right. So if I'm paying, know the rules. All right. Just know the rules. First of all, you need to clear with which one do I need to divide or to multiply. At this case, at that level, you have already determined that, oh, okay, fine. The amount in question that is to be solved here is the Indian rupee. The Indian rupee, according to the quotation of the interest rates, of the exchange rates there, is actually a counter currency, not a base currency. All right, or the quotation currency. So in that case, we are multiplying. All right, now we are multiplying, but the rule is you must suffer. The rule is in finance, we should be on the bad side, on the disadvantage. Okay, must be at a disadvantage. So in this case, if we are multiplying, obviously, and we are paying, okay, we are not receiving. This time, this is a payment. So we need to pay more rupees. So in this case, we are going to pick the higher rate, which is this one. So we are going to multiply this amount and the rate, and we get the amount of the rupees we have to pay. Are we together? If it was a receipt, we are going to multiply again. Why? Because of the quotation, the quotation, the rate there. All right, the rupees we are going to receive in the quotation of the rates, they are a counter currency, not a base currency. So in that case, we are going again to multiply, but multiply with what rate? With the lower rate, because it is a receipt and we have to receive very few monies, very few rupees. Please replay this, because you are going to fail. If you don't follow these rules, you are going to fall. These are the rules which are going to apply until we finish this current risk issue. That the rules, be it in a forward contract, we are going to use the same rules. Even in a money market hedge, we are going to use the same rules. I hope my battery is going to sustain. Let me try to proceed. So there are various methods of hedging transaction exposure, right? In the above examples, our answers are hopefully correct, provided that we convert the money at the spot rate. The problem is that if the transaction is not going to take place until some time in the future, the exchange rates tend to change. So there are various ways to, protect ourselves from these future changes in the exchange rates, which could be adverse in most of the times. So that protection is what we call hedging. Just think of a hedge around the boundary, on the boundary of your premises, the hedge. So it protects you from wild animals and so forth, even snakes, right? So we can do what is called invoicing in home currency. Sometimes it is better to just say, people who want our services should just pay in our home currency, like the pound sterling for organizations in the United Kingdom, like for example the ACCA, the ACCA. They just invoice you in their home currency, the United Kingdom pounds, right? So if they do that, they don't have to worry about any exchange rate movements. The only problem is that if there is another competitor that offers the same service, they're going to be out of business. This is why, in most cases, very few people, they go for the ACCA only for the, if not only for the advantage they have that they are an international accounting organization. Otherwise, if they were some riffraff, some non-entities, they were going to be out of business. Are we together? So people consider, the aspect of international mobility, international reputation, to be part of the golden fleece of accountants. So they then say, oh, even if they invoice us in their home currency, we are going to look for those pounds and pay them. We don't care. All right, are we together? And with the advent of electronic financial or money transfer systems, there are no more headaches of looking for pounds. You just have to ensure that you collect N of the international currencies, which could be converted easily through those money platforms, money payment platforms, which are electronic. For example, the Visa, the MasterCard, whatever, the Stripe, and then you pay the invoice. So it's highly likely that these guys are always going to be in the business because technology is actually at the advantage again. So basically, we are simply saying invoicing the home currency is just invoicing in your functional currency. Okay, for example, if you are a Zimbabwean business and you have got some international presence, you just have to price your commodities in the ZiG, the Zimbabwean gold currency, or Zimbabwean dollar. Okay, something like that. Then there is what is called leading and lagging. To lead is to pay in advance. Sometimes it's good for you to just pay in advance so that whatever exchange rate movement that is going to happen, you are not going to worry because you have already settled and you are just waiting for your products to come. This is normally useful in a volatile trading environment where these people, they'll just say, okay, fine, the invoice is valued for so much and is subject to change in line with exchange rate, what. You're not going to suffer any changes because you have already settled your payment and you're waiting for the goods. The only problem is that you need to ensure that those people are trustworthy and they have got a good reputation. Sometimes they're not going to deliver you goods, or sometimes they're not going to honor the contract if they see that there is a severe adverse in the movement of exchange rates, which they might then start to dilly-dally in the performance of their obligation. There's also a challenge in terms of cash flows. To use your money today is likely to cost you more. All right, I mean to pay today is likely to cost you more if maybe tomorrow there was going to be a benefit in the movement of exchange rates. Sometimes they are beneficial. So you need to keep your dollars with that anticipation that maybe tomorrow the exchange rate will be in your favor. So it is better to keep them and pay later. But you also need to consider, supplier rapport. Because if you are a person who always pay first, obviously you're not going to run out of stock because suppliers are always going to keep something for you, knowing that a good customer is always on standby. Okay, so some of these things would be tested in an essay question that requires you to write something, so you always have to think outside the box. Now let's talk of lagging. Lagging simply means delaying. Okay, you might decide not to delay, not to pay early, but there is a disadvantage, which is an advantage to leading. If you in leading, there could be some advantage in terms of early settlement discounts, but in lagging, yes, there is a cash flow advantage in that you keep much of your money with you until you are satisfied that you can now pay. All right, but there is a disadvantage in terms of lost discounts. You may lose some discounts because of those delays. Okay, the early settlement discount is going to be lost. There's also going to be a challenge with your reputation with suppliers. Sometimes they're going to consider you as a second-hand customer, somebody who doesn't need to be given some priority, and that's not good for your business, obviously. Then netting. In netting, we are simply saying that if we have got if you have got some liabilities and some assets, we can net them off. Some payables and receivables, we can net those items and arrive at some some net position. Okay, what about matching? What is matching? Okay, in matching, we are simply saying that uh, assets, assets and liabilities, the liabilities with similar risk characteristics are merged uh, together. Okay, let's say you are operating in a country that has got a certain risk profile, right? Uh, and you have got also operations in other countries. Then what you need to do is to ensure that the assets in, say, a foreign country should be matched with liabilities with similar risks in that country. Okay, so it's an aspect of like and like. If your assets are longer term assets, then it's better. I mean, if your foreign assets are longer term assets, it's better as well to also fund them with long term liabilities in that particular environment. So you just have to match. This will limit your exposure in interest rate movements. As this, by the end of the day, these, they set off against one another, and thereby limiting your exposure to whatever exchange rate movement that might happen. Okay, that's all, but you can improve on this with the aid of a textbook and so forth. All right, um, so these could be considered, internal methods. All right, they can be considered internal hedging methods. All right, but they are also what are called external methods. All right, or special techniques which could be used. You could use what is called forward contract in hedging against foreign currency risk, or money market hedge, right? These ones expect calculations for these first two, right? But these ones, you need to know the theory, because you are going to be asked to discuss them. You are going to be asked to discuss them. All right, because there is no Zesa, as you can see, my room is getting darker by the day. There's no electricity, guys. So I'm shutting down. I'm continuing with the recording as soon as electricity comes by. So we'll continue on internal hedging methods, right? We'll continue on this, but there won't be any need, because we have spoken much about them, right? These are the things you might need to worry about, to know the advantages and disadvantages, and I've actually spoken much about this, right? We talked of these matching receipts and payments and so forth. You should as well know, know some of these, but I think I will need to discuss more on netting when I come back, right? So that's the idea, ladies and gentlemen. We are going to do an example together on netting. So do not worry, just hang on, you're a soldier. You have been strong so far with me on this long journey, but do not tire, because the rewards are going to be excessive. Until we meet again, ladies and gentlemen, please feel excited, and I mean it, very, very excited. I would amalgamate the videos or just post them as they are. The shorter the shorter the videos, the higher the interest in watching them throughout the end. But sometimes people might not like the idea of looking for another video of that. They just want to go, continue watching it uh, as just a medley. They want something that is a bit continuous. They don't want to be interrupted because they know this device just puts a pause if you want to take some snacks and so forth. So, ladies and gentlemen, I don't know. I'll do whatever that is going to be better for you. Okay, so expect a longer or a shorter video, but please just ensure that you replay. I mean, you watch the videos to the end and attempt the assignment which I sent you, because this is not only going to help you, or the presentation itself is not going to help you much unless you do the assignments within the stipulated due dates, because these are weekly assignments. They are weekly videos which should be watched weekly, and we update them very, very frequently, and you need then to attempt the assignment. You discover that when you did the assignment last time, they are now different. Why? Because each exam session we learn new things and we update them in line with the ACCA syllabus. We don't want to keep on testing people on things that we know they're not going to be tested by the examiner, because the syllabus would have shifted. So bear with us in that regard. So for now, let us call it a day. Thank you. Hello, ladies and gentlemen. How are you? I hope you're fine, wherever you are. I'm glad we are still together in this lecture series on risk management, where we are looking at several aspects, including the hedging of foreign currency, as well as interest rate movements. Okay, so we are continuing with the foreign currency risk management, where we touched on aspects to do with internal hedging. Okay, where we'll be, a company will be using whatever resources it has, or whatever advantage it can make internally to ensure that it protects itself from adverse exchange rate movements. Okay, so far we have touched uh, invoicing. Okay, we talked of invoicing in local currency. Okay, talked of where a company can simply just invoice in their own currency. All right, we also talked of matching, where we said that payables, or let me just say payments, are matched with receipts, are matched to receipts of the same currency. Okay, if you are operating, let's say in Mozambique, if you have got a branch in Mozambique or South Africa, you can then say that whatever payments that are required to be made that side should then be done by receipts which are also made in that side. All right, so this requires a company having several bank statement, bank accounts, which means we can open a bank account which is denominated in South African rands if we are in South Africa, or Mozambican metcash if we are in Mozambique, such that whatever payment we make, we should as well do that with the receipts which are denominated in that currency, which have been deposited into that bank account. That's matching. All right. This can as well apply to payables and receivables, where we say whatever payable we have, or obligation we have to make, that should be settled in the respective receivables. So that's assets and liabilities matching. All right. We also talked of leading and lagging. Leading and lagging. Please replay the video where we say that leading, that's paying in advance, whereas lagging, that's delaying payments. All right, everything has got its own advantages and disadvantages. For example, if you're looking at matching, sometimes it's impossible to get a a receipt in that uh, currency. Only maybe by the nature of your business, maybe you are likely to make payments in that currency, but not to have or to expect to receive any receipts. So sometimes to match those two, you might fail to get the other side of the matching technique. You might fail to get maybe the receipts or maybe the payments which require to be settled in that currency. So that's the advantage. So by the end of the day, you will be forced to use other currencies, and then in that case, you will be exposed to the exchange rate movements. Now, uh, in leading and lagging, sometimes to pay first has got a disadvantage in that you are going to lose cash flows, which would be required on other area which needs some prioritization. Okay, you will discover that maybe if you had waited, maybe that problem could have been solved by the available funds, but you have already paid that money. So there's a challenge in terms of cash flow or liquidity management. All right, but there's also a set of to that disadvantage where you can then receive early settlement discounts. Right, you can as well improve your credit rating, or let me just say your goodwill with suppliers who will be happy to supply you if you are paying very early, right? The lagging side is also the opposite of the leading, right? Lagging sometimes has got some advantage in terms of cash flow or liquidity. You'll be having money and you delay paying, which means you're not having pressure on your cash flows. But that might impact you to, that might cause problems with suppliers who might, feel you are not a serious customer, right? Who needs to be given some priority, right? So all those are considerations which you need to tell the examiners when they ask you to discuss about the advantages and disadvantages of all these methods. Now, what about invoicing in local currency? If we are going to invoice in local currency, yes, we are not going to get the headaches associated with exchange rate movements. However, we are not going to be very, very competitive because other customers will be annoyed to do business with a company that is so rigid, that doesn't want to be flexible, to accept other currencies which they have. In that case, you will be out of business, you will be losing business. So those are the considerations which you might discuss. Now, let's move on to this other internal hedging technique that is called netting. Okay, there are two forms of netting. There is bilateral and multilateral netting. All right, netting has got to do with netting off of intercompany balances. All right, before we arrange payment, we need to see. We just have to pay the net. All right, we would first of all, I mean, identify our intercompany receivables, and then also the payments, the intercompany payments. Then after we then get the net difference, then we arrange for payment. So bilateral netting involves only two group companies. But as the group grows, we end up doing what is called multilateral netting, where we now have several group companies participating. All right. Okay. Now, like I said, in bilateral netting, we will be only looking at netting of receipts and payments between two group companies, right? So that one is not really going to be a problem. But in the exam, expect to encounter a question that requires you to do what is called multilateral. Net, as you can see on the screen there is this particular problem. A group of companies controlled from the US has subsidiaries in the UK, South Africa, and France. Okay, as at 31st December, the intercompany balances were as follows, right? So this is the typical table you are likely going to face in your examination. All right, so we have got the receivables column, the payables column, the balances, and the currency. So what does this imply to you? All right, so the payables column, this simply talks of the amount owed by, all right? Whereas this one, so for example, if you're at the payables column, right, we can see that the French, company is actually owing South Africa, all right? The French, if we are looking at this particular point, okay, the French the French company is owing the South African company the 375,000 euros. All right. Then, if we are looking at the receivables, we can see that these amounts are owed to. All right. So what it means is the South African company is expecting, okay, the amount or the French company, all right, the French company is actually owing the South African company 375,000 euros, right? Or in other words, the South African company is expecting to receive 375,000 euros from the French company. All right. But before we get the sense of all this, we then need to understand that by the end of the day, we need to convert all these amounts. All right, we need to convert, as you can see in the current column, there are a lot of currencies. You can see different currencies, but we have been told that this company, the controlling company or the parent company, is in the US. So all these payables and receivables, they are going to be converted to the US dollar, all right, by the end of the day. So before we convert, we then we need to before we pay, we do the ultimate payment, we need to ensure that we have netted off the payables and receivables, such that by the end of the day we are left with the amounts that need to be paid or to be received. Okay, sometimes the payment might be lower than the receipts, and that in that case we will be having an ultimate receipt. All right, we can't force things to pay when there is no need to pay. Okay, that's what I mean. All right, so to change these into dollars, we need some exchange rates, right? We need to translate the balances into USD. So the question is actually saying calculate the net payment between the subsidiaries after netting off the intercompany balances. All right. So in that case, we need then to understand if really we are going to be in a net payment position. All right. Remember the main reason for doing netting is to ensure that we only pay the net amount. We're only going to pay the net amount after netting off whatever receivable and payable that was there. All right. So there are some steps to be followed, right? But in the exam, you won't have time to ask yourself, did I do step number 1? Did I do step number 2? And so forth. But this helps you to be systematic in your computations. So first of all, you need to convert the outstanding balances to a single currency, to treasury function or parent company's currency. Then you need to set up a transaction mix. Third, you need to transfer converted balances to the transaction matrix, right? So this is actually a transaction matrix, right? So you need to transfer converted balances to the transaction matrix. Then total columns owed to and rows owed by. You need to establish that table. Net of balances owed to and from. Then lastly, conclude on the net balance. Okay, once you have satisfied the steps to be taken, you then have to do the conversion. All right, like I said, first of all, you need to establish which amounts are owed to and which amounts are owed by. Right. So, like I said, if you're looking at this particular column, this is the the column actually shows that those companies are being owed by the companies on the receivable side. All right, so it actually it's the amounts are being owed by these companies. For example, this company is owing the South African company so much. All right, it's owing. After we convert, remember we have been given the rate. This was the rate for the euro, because France is in Europe. So the exchange rate for $1, okay, needs 5.880 euros. Okay, $1 needs 5.880 euros. And you can still use that method, that if the dollar is actually the best currency, if the rate is saying that per dollar, then if you want to convert the amount given to dollar, obviously you need to divide. Okay, this is why we are dividing there, and we get this amount in dollars. All right, so on the payables, the owed by, we are simply saying that the company in France needs to pay the company in South Africa such amount. All right, then here we are saying that the South African company is owing the French company, so that these amounts in this column are owed to these guys. All right, guys. All right, so that's what it means. All right, but you need not worry much about that. All right, with practice you understand what we're trying to say. All right, these are the payables, the receivables, they are amounts. All right, they are amounts. All right, so A payable is an amount owed by a certain by the company to another. All right, it is an amount owed by the companies in this column. All right, to these other guys. All right, but the receivables are amounts owed to. All right, they are amounts owed to the companies in the payables column though. All right, so that's the trick that can be, but so you just have to tell yourself that when you see a receivable, okay, it means that what I find, the UK company is the amounts for the UK are actually amounts which are owed to this particular UK by the South African company. They are amounts owed to the UK by the South African company, which is in the payables section. But when you are looking in the payables column now, you then have to then move from the payable to this side, telling yourself that, oh, so the South African company is being owed by a UK company. All right, that's the trick. All right, but this is why I said you need to follow the steps. If you establish these first steps, then you're home and dry. All right, so the first step was to convert these amounts using the appropriate rate. For example, if we are talking of the UK, we need to understand what denomination was the currency in, and this was a South African amount, right? The South African amount. So we are going to use the South African rate. The South African rate to dollar, we're told that this is 6.126 rands per dollar. So if we want to convert the 1.2 million into dollars, we then have to use the rand rate, and we are going to divide the 1.2 million with the 6.126 rands, and we get this amount. We also do the same. We need to understand, okay, that the amount, was it denominated in euros or rands? This was a euro amount, okay, 480,000. So to convert euros, all right, into dollars, what do? We go to the euro dollar rate, and we get this one, 5.880, and we're going to use that one as the rate, and we get the USD. Similarly, we ask ourselves for the France South Africa, right? Remember, this table, you create it by yourself, right? The examiner is going to tell you, but if you lead yourself, much of the information will be taken from the table given by the examiner, and it then have to, improvise with your own columns. Like, for example, the examiner has given you the balances, but the rates you have to input themselves. You have to input them by yourself, right? And this column is your own origination. Then we come to the France South Africa trade relationship. We ask ourselves, the 800,000, was it in rands or in euro? This was in rands, South African rand. So we then go to the rate that involves the rands, and that was 6.126 per dollar. We come here and use that one to get this much. Then we ask ourselves, 740,000, was it a euro or it was a Great Britain pound, GBP? All right, so in that case, we are going to use the pound dollar rate, and we get 0.680. We just do the division, and we get those dollars. Then lastly, 375,000 Was this in rands or in euro? This was euro. All right, so we use the euro dollar rate, and we get that one 5.880. All right, in the exam you need to go on fire because there won't be much of the time. Now, once we have done this, we then have to construct the transaction matrix now, where we have got the odd by in columns, and then the odd to in rows, something like that. Okay. So okay. All right. So all right, the odd two, those ones are the total columns, odd two, and the rows are the odd by. We need to have those columns. All right. So we come here. All right. So the odd two, right? Odd two are actually in columns, right? Whereas the odd by, they are in rows. Okay. All right. So what it means is, like I said, most of the information you need to lead yourself. Otherwise, it's not hard and fast that the odd by should be on top, or should be rows, and then the odd two should be columns. You just have to, by the end of the day, the matrix, you need to understand what will be happening with your figures. All right. There are three companies we are talking about here. We've got the UK company, right? UK, SA, and so forth. And then on top again, your columns should also be UK, SA, and so forth. And then you get your totals. All right. So these are the total for the odd by total. All right. And we also excuse me, it's actually not odd by, but odd two. All right. So good. So that's the odd two total. All right. Now, total will get the sense. Since now we want to understand how much was the UK amount, how much was the amount owed to the UK by the UK, we can see that the company cannot owe itself an amount. So this is why we put a 0, right? But how much was owed to the UK by the South African company, right? How much was owed to the UK by the South African company, right? So if we go back to our, our table here, all right? The UK company, right, was owed. The amount that was owed to the UK, right, by the South African company, according to our computation, was this much when we did the conversion. So we come back and slot the number here, or the amount. All right. Then we ask ourselves, was the UK still being owed by any branch? Right? So we can as well see that there was also, the UK was also having an amount to which it was owed, right, by a French company, and this amount happens to be 81,633, and this is the amount which we have put there. Okay, then we ask ourselves, we have finished the UK, then we have to move on to the France. What amount was being owed to the French company by the South African company? We discovered that it was 130,591. So we come here and say, France, where are you? And okay, France was being owed by the South African company 130,591. Then we ask ourselves, was there another company still outstanding? All right, we've done the UK, the French, now the South African companies. All right, South African companies, was there an amount which was being owed to South African, which is a receivable, an amount which was being owed to South Africa by a UK company? And we have discovered that this was 108,824. So South Africa, UK. South Africa was being owed by the UK this amount, 108,824. We ask ourselves again, was there still another amount to which the South African company was owed? And we discovered that yes, it was there. It was being owed by the French company, and this happened to be how much? Something like 63,776, and we have to slot it in there. All right, so we then have to calculate the total owed by and the total owed to, right? And I said this is the column for the total owed to, right? And the total owed by, okay, sorry, my pen, right? The total owed by and total owed to. All right, so how do we get the total owed to? The total owed to, you just have to add everything in the rows. All right, so for example, we start with the UK row and we get this amount plus this amount, and we get that amount. We go to the South African row, we add this amount and that amount, and we arrive at that. We go to the French row and we get only this amount, which is going to be the total in the owed to. What about the owed by? Owed by. All right, the owed by, we just have to add down the columns. Okay, add down. So we can see that in the first column for the UK, the total is this much. In the South African column, the total is that much. In the French column, the total is that one. All right. So we then have to separate. We then have to pick these totals and slot them retrospectively. Respectively. All right. So we just slot them there. This one has to come there. All right. I'm sorry, some of the figures are now being obscured by my writing. They are obscured. All right. So by the end of the day, somebody might be asking, why are we subtracting the total owed to from the total owed by? Why are we putting brackets in the owed to when we had said that no, these ones were receivables? Sorry. All right, the owed to were actually, according to this, owed to were receivables. So why are we, subtracting them, something like that. All right. By the end of the day, we need to determine the difference. Okay, by the end of the day, we need to determine the difference. All right. Okay. Nevertheless, that type of curiosity is uh, encouraged, is justified. All right, because we need to be consistent with our ideas. So let me just label this. The total owed by, we say that the owed by were receivables, and the owed to, sorry, uh, the owed by were actually payables, right? So allow me to rub off, ladies and gentlemen. And the problem is when I rub off, everything goes off. It doesn't matter. All right. A clean dashboard is a clean board is the right thing to have. So the total owed by, these ones are actually payables, and the owed to are receivables. We are in agreement. Okay, we are in agreement. So the payables, somebody is worried that they are positive and the receivables negative, so they are justified. But my justification for doing this is that by the end of the day, we need to find the difference. Okay, we need to find the difference, and by default, our additions should be positive by default, okay, because the total should be positive, as the figures themselves are positive. As you can see here again, the figures were also positive. All right, so by the end of the day, to get the difference, we need to then put negative figures here. All right, good. But by the end of the day, you then have to follow to be systematic, to understand what is going on. All right, like I said, these figures have been imported. This is 277. We've just put the 277 here. The 172 has been slotted here again, just in line with the numbers. This was South Africa, and we have put the figures here, which is a South African column again. And this one is a total for France, for the row, the France row, and we have slotted it in the column for the France. All right, good. Once you have ascertained that, you are good to go. So you then have to be able to interpret what will be going on. All right, we said that this was an owed by, this was a payable. All right, say these ones are payables, they are owed buys, they are payables, isn't it? We need to be systematic, isn't it? All right, so the payable in this case was larger than the receivable, so we are going to get the ultimate payable, isn't it? Good. We come here again to this column. The payable was larger than the receivable, so the ultimate is also a payable. Then we come here, the payable was smaller than the receivable, so the ultimate should be the receivable. This is why we have written owed to. Okay, this is an amount owed to. It's an amount owed to the UK, whereas these ones are amounts owed by South Africa, and this one by France. So what is the interpretation? Therefore, the South Africa and France branches are owing the UK in total, that is $168,695. So, ladies and gentlemen, that's the multilateral netting. Please just to replay this video. Be comfortable with the figures. Be comfortable because this is likely to come, likely to be examined. This is likely to be examined. So you need to be comfortable with it. Otherwise, you are going to face fire. All right, so let's move on. I think we now have to jump to the external hedging techniques. Okay. Okay, guys. Thank you so much for being this patient as we continue to tame the jungle on risk management. In particular, we are looking at exchange rate, or let me just say current risk management, okay, or exchange rate hedging techniques. Okay, we are looking at those techniques like for example, the use of okay, do I have another color here? Because I want another color. All right, seems like this is the best color I can have. All right, so we are looking at what are called forward rate. Forward agreements. Okay, or let me just say exchange rate forwards, exchange rate forwards or forward contracts. Okay, forward contracts. We're looking at or sometimes they are called forward market hedges. Okay, forward market hedge. We are also looking at the money market hedge. Right. We can also look at what are called current futures. Current futures, current options. All right, this is to name but a few. Okay, but in the exam, expect some computations on the first two. Okay, and these other ones you are only required to discuss their theoretical aspects in this particular syllabus. You expect some computations as you proceed with your ACCA journey. All right, so forward exchange contracts or forward contracts. I'm sure by now you have the idea of what a forward exchange rate is. We have been talking of certain theories which look at these things, right? There was a certain theory which actually is used to forecast a forward exchange rate. Okay, I think that's the interest rate parity theory. Interest rate parity theory. Theory. All right, the IRPT, the interest rate parity theory. It actually is used to forecast this exchange rate. So a forward exchange rate is the rate at which two currencies will be exchanged at a specific date in the future. All right, so it's not the spot rate, it's not a spot exchange rate. All right, The forward rate reflects market expectations of how the spot rate will change between now and the future date. So instead of quoting the forward rate directly, it's often expressed as a margin on the spot rate. Right? This margin represents the difference between the spot rate and the forward rate. It's usually expressed in points or as a percentage. More on this later, but sometimes when we talk of points, we are also talking of basis points, something like that, and we have already talked of the basis risk and so forth, all those things in our initial discussions on this topic. All right, so how do these forward exchange contracts or forward contracts hedge current risk? All right, there are common tools. There are actually common tools which are used to mitigate this type of transaction exposure. What they do is they lock in an exchange rate for a future transaction, eliminating the risk of exchange rate fluctuations. Because remember, we have already highlighted that the problem with Forex is that the exchange rates always fluctuate. Sometimes the fluctuation could be favorable, sometimes it could be adverse. So if you enter into a forward contract, you are trying to mitigate the adversarial movement of the exchange rate. So let's look at this illustration. YPLC will receive 10 million on 3rd April, which is a future date. They enter a forward contract to sell this amount at the rate of $60 per pound. Right? So they have decided to enter into a contract to sell the similar amount, okay, because they are going to receive this amount sometime on 3rd April, but they've then decided to enter into a forward contract to sell the amount at the rate of $60 per pound. This guarantees them about 6.25 million, and I'm sure you know how to obtain this. So if we say 10 million divided by 1.60, all right, let me use my calculator here. Right, 10 million divided by 1.6, that's 6.25 million. All right, so this removes the currency risk completely. Why? Because we have guaranteed ourselves that come what may, we are going to get this amount. However, by the date or by the 3rd April, the exchange rate could have been, let's say, could have been 1.50, right? So in that case, we have lost how much? Because if the pound, the rate is now $1.50 per pound, it means that we have lost how much? Divided by 1.5. Okay, we were supposed to have received 6.667 million, right? However, because we have entered into a forward exchange contract, we are only going to be limited to receiving 6.25. So we have lost how much? Minus 6250. We have lost about 416,666. So the problem with forwards is that they are fixed and rigid, which means if the exchange rate moves um, against us, we are not going to turn back and say, please let us be in this particular position, right? So that's the issue. However, if they are going to move, if the rates are going to move adversely uh, uh, in our position, let's say for example, if the interest rate, if the exchange rate has been now 1.72 at 3rd April or on 3rd April, it means that we are going to receive very few pounds. So if we have already entered into the forward contract, it means that we are protected from those adverse movements. So it's a win-win situation. Sometimes we benefit, sometimes we lose. But it's better to enter into this because it guarantees us something. In other countries, because of these exchange rate movements, sometimes all your investment can come to zero because of these exchange rate movements. Sometimes they are very drastic, they are very cruel. So you need to enter into some sort of hedging. Hedging simply means that some protection, that the hedge on your boundaries is some form of protection from wild animals, from snakes, etc. So hedging is actually very, very important. So what are the advantages of forward exchange contracts? All right. Number one, flexibility. They can be tailored to cover the exact amount of currency exposure. They are available in many currencies, right? They are not standardized, so you can tailor them to the exact amount you want to have covered. They are easy to use. They are relatively straightforward to understand and implement. Then they guarantee a specific exchange rate, providing certainty for budgeting and planning. All right, as you have seen that we were guaranteed to receive 6.25 million pounds. Right. Disadvantages and consideration. Contractual obligation. A forward contract is a binding commitment to exchange currency at agreed rate on the specified date. This can be problematic if payment is delayed. Sometimes the payment could be delayed and so forth, and this could lead to some litigation. All right. Being a contract, something that you need to do your part. If you don't do your part, they'll drag you to prison or to face some courts of law. Missed opportunities. No opportunity to benefit from favorable exchange rate movements. As you have seen, that sometimes when the exchange rate should have been on your favor, you are going to miss it because of the contract which you have already entered into. There won't be any chance to turn back. Inflexibility. Can be inflexible if the timing of the currency flow changes. Mitigating inflexibility. Option date. Forward contracts allow settlement within a range of dates, offering more flexibility in the exact payment date. If the exact payment date is set, this helps mitigate the risk of late payments. All right, so here we are simply talking of options on forwards. Options on forwards. They are there, right? Which they are over-the-counter options, which offers this type of flexibility where we will be having some option to turn around to then try to exercise if it is to our favor or not. Although options, they have got some risk associated with some payment upfront, for you to, for the other party to be interested in doing business with you. So the key takeaway is that forward contracts eliminate downside risk, but also forego potential upside gains from current fluctuations. Carefully weigh the benefits of certainty against the potential for missed opportunities. You need to, be comfortable to see if you are ready to lose the upside opportunities. Sometimes you might be frustrated after entering into these contracts when you then see that you are now failing to gain some mileage when you could have done so. Okay, what's happening? It's sticking. All right, now there is this particular question which I think if we do together, don't mind having the solution on the screen. For learning purposes, I think it's very efficient, such that we discuss how the solution is that way, rather than to spend much time trying to show our quantitative abilities. All right, so X is due to pay $200,000 in 1 month's time. The spot rate, that is the exchange rate today, is $pound 1.4820 to 1.4905, and we have already pointed out that the difference between the two quoted rates is what is called the spread. 1 month forward is quoted at $pound 1.4910 to 1.4970. All right, so that's the forward rate. Okay, if X contracts 1 month forward, or if X enters into a 1 month forward, how much will he have to pay in 1 month's time? All right, the same rules apply. If it is a payment, all right, always tell yourself that I have to pay more. You need to pay more. All right, that's the first rule. It's a payment, you have to pay more. If it is a receipt, you have to receive very few. Okay, now the currency is in dollars. The exchange rate is quoted dollar per pound, all right, which means the pound is the best currency, all right, and we want to convert this into pounds. So what it means is we need to divide, all right, we need to divide, right? So that's the other rule you need to remember again. All right, we are converting into the best currency. The rate has been quoted in best currency. All right, so in that case we are to divide. Then what else now? We need to pay more, so we need to pick the lower rate because we are dividing. So pick the lower rate. All right, so we are using which rates? We are using the 1 month forward, all right, and we are given two rates, this one and that one. So which one is lower? The 1.4910. So this is why we have used that one. So you can see that having the solution on the screen there, but discussing it is actually very are beneficial for learning purposes. Are we together, ladies and gentlemen? So we are still consistent with our initial teachings, with our initial techniques, that when you are faced with a payment transaction, or first of all, in any transaction, whether it's a payment or a receipt, you should be at a disadvantage. That's the idea, that's the rule. So your disadvantage in a payment situation is that you are going to pay more. If it is a receipt transaction, you are going to receive less. That's your disadvantage by the end of the day. So whatever rate you are going to use, it should be at your disadvantage. That's the idea. Okay. However, this disadvantage doesn't mean that financial managers are reckless. No, they are not reckless. They are simply following the rules of business. Remember, the providers of this forward contract and so forth, they are people in business. They could be banks. They are banks which have been established to maximize shareholder wealth. So they are in business. However, the disadvantage is not so significant to send you out of business. No, because you are going to be guaranteed you are going to get some guarantee in the movement of exchange rates or interest rates, whichever case might be. Are we together, ladies and gentlemen? Okay, so don't say, oh, the tutor told us that we should always be on the disadvantage, so therefore we have to be reckless. No, that's calculated risk. That's not recklessness. It's calculated risk taking. All right, let's move on. Do we still have another? Okay, the aspect of margins, right? The aspect of margins. You can read this, you can pause and read this particular part, all right, and understand. But like I said, sometimes these rates are coded. They are quoted in terms of margins, right? So margins are typically quoted in points or pips. A point or pip is the smallest unit of change in a current quote. For most currency pairs, a point is equivalent to 0.0001, that is 1/10,000th of the code. However, for some currency pairs, especially those involving the Japanese yen, a point is equivalent to 0.01. All right, let's look at example 6, the USD British pound. Let's say the spot rate for USD GBP is $0.2500, and the 3 months forward margin is quoted as 20 points at a premium. 20 points at a premium. Let's calculate the forward rate. So 20 points is equal to 0.0020, right? Okay, now because it's a premium, we subtract the points from the spot rate. For USD British pound, a premium means the USD is expected to strengthen relative to the British pound. So the forward rate would be the current spot rate, okay, minus the premium, and this would give us the 1.2480. Okay, this means that in 3 months you can expect to exchange 1 British pound for 1.2480 USD. Please, if the forward is quoted at a premium, always know that you need to subtract from the spot rate. You need to subtract the points from the spot rate. If it is being quoted at a discount, you then have to add the points to the spot rate. As simple as that. Let us do this example. Y is due to receive $150,000 in 3 months' time. The current spot rate, that is the rate today, the exchange rate today, is $pound 1.53 to 62 1.5385. 3 months forward is 0.62 and 0.51 cents premium. Okay, so the P there, the P you are seeing, the PM is actually the premium. If it is the discount, usually they say this. Okay, this. So that's the quoting of the forward. So you now know the principle. The forward is quoted at premium. So how much will Y receive? Now, this is a receipt, and our position is to receive few pounds. Okay, after converting the dollars into pounds, we have to receive very, very little pounds. Right? That's the rule book. That's the rule book. So to do that, which 3 months forward are we going to pick before we do any adjustment? Shall we pick the first one, or which rate shall we adjust? Remember, we need to adjust the spot rate with the premium so that it becomes the forward rate. So which spot rate between the two shall we pick? That will enable us. Remember, we are dividing because the base currency there of the court is actually the pound, and we want to convert into pounds. So we are going to divide whatever forward rate we are going to come up with. So in this case, we are going to pick the higher rate. All right. So first of all, we're going to pick 1.5385. Then, because we now know that the forward is quoted in premium, at a premium, therefore we need to subtract the points. But this time we're given 2 points, 0.62 and 0.51. And our rule book is that we need to suffer. We need to get as fewer pounds as possible. So by the end of the day, we are going to subtract a little bit. We are going to subtract with a very small amount of points. Are we together? But now, these ones are in cents. Remember, they are in cents. So to turn them into points, to turn the cents into points, we then have to divide by 100. So we are going to divide the 0.51 by 100. And what do we get? So the rate becomes 1.5385 minus 0. Let me use my calculator to verify. 0.51 divided by 100. So it becomes 0.051. So this will give us the ultimate rate of how much? 1.5385 minus 0.0051. This comes to 1.5334. And then if you divide this rate, if you divide 150,000 by that, by this rate, we are going to get these pounds. These are the fewer pounds which we can get. The fewest pounds we can get. Okay, so that's the trick, ladies and gentlemen. If you're given the amount of points in cents, then it means that to bring them to points, then you need to divide by 100. It's simple as that. Are we together? Good. What else do we need there? All right, let's try this example again. Z is due to pay $200,000 in 2 months' time. The spot rate is $pound 1.6550 plus or minus 0.0018. 2 months forward is given as that. Okay, how much will Z pay? All right, this time the forward rate is given. All we then need to do is to pick from the forward rate straight and ignore the spot rate. This time it's not necessary. Why? Because we have been given the forward rate plain and explicit. So we just have to pick the right figures, adjust them accordingly, and solve the question. So we are about to pay. So this is a payment and we need to suffer. That's the rule. So we need to pay more. If it is a receipt, you have to receive less. Now, here we have to pay more. So obviously we need to then adjust, because remember, we are dividing. The rate in this case is to divide. Why? Because the rate is quoted in $pound and you want to convert the amount to pounds. So therefore, to convert those dollars to pounds, we need to divide. So to pay more, it means the denominator should be lower as possible, as low as possible. So we then have to say, all right, initially the rate is 1.6623. Shall we add or subtract to ensure that the denominator gets more lower than it is? Obviously, we need to subtract this amount with the basis points. So we are going to get something like 1.6603. This will ensure that we are going to pay as more pounds as possible. Are we together, ladies and gentlemen? This is how we obtained this rate. Okay. Now, this is the headache for many students. Money market hedging. Okay. Money markets are markets for wholesale, large-scale lending and borrowing, or trading in short-term financial instruments. Many companies are able to borrow or deposit funds through their bank in the money markets. The money market hedging approach involves converting the foreign currency at the current spot, which therefore makes the future changes in the exchange rate irrelevant. However, if we are, for example, not going to receive the foreign currency for 3 months, Then how can we convert the money today? The answer is that we borrow foreign currency now at fixed interest on the strength of the future receipt. So here we have been given a tip. If we are not going to receive the foreign currency for 3 months, that is, if we are going to have a 3 months foreign currency receipt from now, we can't convert that, okay, because we don't have the money now. But what we can do is we can borrow the foreign currency now at a fixed interest rate on the strength of the future receipt. Okay, we'll be able to repay whatever borrowing we have made, because obviously we are waiting for money in 3 months' time. Now, let's look at an ACCA FM exam section B type question, which would assist us to understand these principles in detail. Hedge company is an Australian. Okay, this company, let me shift my picture there. Okay, Hedge company is an Australian firm currently manufacturing a large item of machinery, which is due to be exported shortly to the United States. The sale has been priced in US dollars. The client is expected to pay $850,000 US dollars. This is Hedge company's first sale to an American client, since most of its exports normally go to Asia. The client has agreed to pay Hedge company 3 months from now. So this is a 3 months expected receipt. All right. The following relevant additional information is available. The current rate, the spot rate, is 0.7233 US dollars to Australian dollar. US dollar interest rate 3.3% per annum. Australian dollar interest rate 2.9% per annum. So those are annual rates, right? And we have been told this is a 3 months issue. So obviously we need to adjust to prorate our rates there. What will be the Australian dollar receipt to the nearest $1,000 if the transaction is hedged using the money market? So this is a receipt, ladies and gentlemen. It's a receipt, right? So but it should be in Australian dollars, but the customer is to pay, he just has to pay $850,000. He doesn't have to sweat about where to find Australian dollars, but we, the company which are concerned, we need to ensure that we enter into some money market hedge and protect ourselves from adverse exchange rate movements. There is a risk that by the time we are going to receive this amount, maybe the Australian dollar would have been gone very, very far above. The exchange rate would have made the US dollar weaker, such that it will be valueless to receive that amount. All right, so we need to enter into some form of hedge, which is the money market hedge. All right, so the idea is, because this is a receipt, we need to borrow forex now. All right, we need to borrow forex now. All right, so we need the present value, the 3 month present value of the forex amount. Remember, the forex amount was $850,000, right? So we need to get the present value. Okay, the PV, remember the PV formula is equal to the amount, okay, or the future value, right, multiplied by 1 over 1 plus R to the power n. Okay, so I mean, that's how we compute the present value. All right, so in this case, this is the same thing we have done here. The future value we are going to receive is the $850,000, US dollars, right? Divided by, okay, divided by 1 plus R, and R is the rate of borrowing. Okay, the rate of borrowing USDs, right? Because do not pick the rate of borrowing for Australian dollars when you want to borrow USD. You have to pick the rate that is like and like. Okay, the rate for the relevant currency. So in this case, we have to pick the USD rate. Okay, the 3.3 per annum. All right, but like I said, even if we pick the 3.3 rate, we need to adjust it for 3 months. So we need to multiply that rate by 3 over 12, and we are going to get this as our rate. That's the borrowing rate for 3 months. So then we come to this. So therefore, the present value is going to be 850,000 divided by 1.00825, and this will give us these dollars. Okay, at least we are following the rules of present value, because the future value is much higher. All right, but in terms of the worthiness of that amount, today that's 843,000. all right, why? Because a dollar today is worth more than a dollar tomorrow. So we are going to receive this amount after so many months, 3 months. So in financial terms, that would be worth 843.045 US dollars. That's the time value of money. All right, now we have borrowed that amount. All right, now what do we do? Remember, we are in Australia, right? We have borrowed that amount. Then what we need to do then is to convert the forex borrowed now at spot rate to local currency. So we need to convert that amount into Australian dollars. So what do we do? We go back to the spot rate. The spot rate is given, right? This is a generous here. The examiner has been generous. Doesn't want to confuse us. All right. So that's 0.7233 US dollars to Australian dollars. All right. So in this case, you can see that the rate is actually 0.7233 dollars per OD. So in this case, you can see that the OD is the best currency, right? That's the best currency, and we want to convert the USD into the best currency. Therefore, we have to divide. This is why we are dividing here, and we get our OD, the Australian dollars. Okay, once you are comfortable doing that, what next shall we have to do? So I said, for the receipt, the first thing you have to do is to borrow. After borrowing, you need to borrow the forex amount, then you convert. After that, you then have to receive. All right, you receive along with interest the local currency amount in future upon investing the local currency. Now, what does that mean? Receive along with interest the local currency amount in future upon investing. So what we are simply saying is that we know we're going to receive this amount of 850,000 in US dollars in 3 months, but we need to hedge, the adverse exchange rate movements. So what we are doing now is we just have to borrow another amount, right? We know we are going to receive something, right? And we need to repay, all right? We need to, we know we are going to receive something, but because of exchange rate movements, that's something we are expecting to receive might be depreciated in value, all right? So to safeguard ourselves, we ignore for now that transaction, right? Because we are not in control of it. We are going to receive it in 3 months. So what we are going to do, we just go to the bank and borrow the same amount. That's what we have done, all right? Borrow the same forex amount. We have converted it into our local currency, but we are not going to sit idle with that money and saying, no, we just want, because the banks will want their money back. We have borrowed them, but they would want that money back. So as clever people, we are going to invest the borrowed funds. All right, we're going to invest the borrowed funds into an Australian bank. Remember, these are now Australian dollars. So we're going to use the same amount. This is the same amount. Okay, we are going to invest it. So by investing, we are hoping that it will increase in value. So if, for example, the investment rate or the deposit interest rate, if you put your money in a bank, okay, don't forget, don't relate these things with your local country or your home country where maybe banks do not give you interest. Just think as if like you're in a country like Zimbabwe where you get interest. If you put money in the bank, you're going to get interest. Okay, your money, the banks are not just going to eat your money with bank charges. No, in Zimbabwe, they are going to give you, some return on your investment. When you put the money in the bank, there is some interest you are going to earn. Okay, that's what we are talking about here by investing. All right, your money is going to accrue some interest. It's going to earn some interest by the end of the day. So it will receive. It will increase in value. So let's say the deposit rate of interest or the investment interest is 2%. So if you had put, let's say, $100 in your bank account, then the interest rate is 2%. So this means to increase this by 2%, it means that we need to multiply by 1 plus 2%. That is 1, it becomes 1.02. That's how it can increase. If you simply multiply 100 by 2%, you're not going to increase anything. So in this case, it becomes 102. So the amount now in the bank is now 102. Okay, so let us then come back to the solution. So I say that we first take this amount which we have taken from this. Okay, it's just the same amount, but we want to increase that one in the bank, and the borrowing, the deposit rate. Okay, the Australian dollar interest rate is 2.9 per annum. So we just assume that that's the rate for depositing. Okay, in a typical money market hedge question, you are likely to be given the higher and lower rate. Two rates are going to be given in each of those, such that you then have to pick the correct rate. But in this particular question, let us just pick 2.9. Now, the 2.9 is for the whole year. We need to adjust it to 3 months. So this is why we are multiplying it by 3 over 12, right? And remember, the 1 here is on standby. Once we have cleared everything in the bracket, we then have to add it to the 1, and we'll come to this position, right? This is our original figure, which is equal to that one, okay? Multiply by the adjusted rate now, 1 plus 0.00725, and you get 1.00725. So if we multiply by 1,165,554, we are going to, this is not actually 1 million, it's 11 million. What's going on? What's going on? That's a typo somewhere. All right, that is a typo. This is a, please forgive me there. That's a typo. Okay, the correct figure is actually this one. Okay, what's a typo there? All right, that's a typo, but okay, it should be 1,165,554 before an investment. An investment, and then after investment, it should come to 1,174,004 Australian dollars 0.27. So that's the idea. So, ladies and gentlemen, this is how you compute your receipt. All right. We have other questions. Which of the following relationships suggest that current long-term interest rates can be used to predict future short-term interest rates? Okay, which of these theories actually can be used to predict future short-term interest rates? All right, you can do this by by elimination. In an examination, you can use the elimination method to understand what's going on, right? The purchasing power parity theory, what does it actually tell us? What is it all about? Interest rate parity theory, what is it all about? The Fisher effect, what is it all about? So you can pause the video and then tell me the exact answer. Good. I'm sure you have guessed, not guessed, but actually identified the correct answer to the question. Okay, now obviously the answer is the expectations theory. Somebody might say, oh, but we didn't cover these in the notes so far. Yes, you need to read wide and aloud so that you cover most of the syllabus areas. Some of them are silent. You need to at least read as much as possible. All right, now the expectation theory. This theory suggests that long-term interest rates are an average of current and expected future short-term interest rates. It implies that if investors expect short-term rates to rise, long-term rates will be higher to reflect those expectations and vice versa. Therefore, long-term rates can be used to predict future short-term rates, which directly answers the question. Okay, so that's an expectation theory. But just for vision's sake, let's discuss the other three theories and find out why they are wrong. Let's start with the Fisher effect. This relates to the relationship between nominal interest rates, real interest rates, and expected inflation. It does not involve predicting future short-term rates from long-term rates. So I'm sure you are still aware of that interesting formula where we say 1 plus I is equal to 1 plus ZR, all right, multiply by 1 plus H. Okay, that's the Fisher effect. All right. Then we have got the interest rate parity. This is a theory in international finance that relates interest rates and exchange rates. It explains the relationship between spot and forward exchange rates, not the prediction of future short-term rates. Okay, please revisit these two formulas. Although they are going to be given in the examination, you need to be very, very comfortable with them because they're always going to be there. And in the previous parts of this lecture series, we have uh, been speaking about these formulae, and you need to master them properly. The purchasing power part theory, on the other hand, deals with the relationship between price levels and exchange rates over time. It suggests that exchange rates adjust to reflect changes in price levels between countries, which is unrelated to the prediction of future short-term interest rates. So this is part of the note which you should pride yourselves with, because although we didn't explicitly talk about the expectation theory, you have and we have covered it now. All right. Thank you. Okay, ladies and gentlemen, for those who do not have the formulas, or we have just seen these videos, this part of the video for the first time, I think it is beneficial for you to see these formulas. Let's start with the Fisher formula. This is the Fisher formula, and if you are doing the ACCA financial management paper, you're going to be given this formula in the exam. This math and formula table is going to be given to you. All these formulas are going to be accessible. You're going to see them in the examination. Okay, of course, other formulas are not going to be given, but most of the formulas which are going to be useful for you to pass the examination are going to be given to you. Okay, so this other one, these two, this one and this one, are the purchasing power parity and interest rate parity formulae respectively. Okay, so the first one, the purchasing power parity, is useful to predict the future spot rate. The future spot rate. So this is the S1, that's the future spot rate. But for us to predict that, we need the current spot rate. Okay, and we then have we also need the inflation rate for the foreign country, that is the HC there. That's the inflation rate for the foreign country. And then in the denominator there, that's the inflation rate for the best country, okay, or the local country or the domestic country where the company would be based, and so forth. Okay, so what it entails is that if the inflation rate of the foreign country is going to be higher, it then means that the future spot rate is actually going to increase. And if it increases, it means if the amount was a receipt and we want to convert this receipt into the domestic currency, it means that if we are given a rate that is quoted in the domestic currency, then it means that we are going to have some few of that amount. For example, if the spot rate was, let's say, 1.250, okay, but now because of the inflation rate that is increasing, that is the inflation rate, let's say it's 5%, okay, over the domestic inflation rate of 3%. If we solve this, you will discover that our S1 is going to be, let me see, 1.25 multiplied by 1.05 over 1.03. So the rate, you can see that it has increased to 1.2743. Okay, so because the rate has increased, if we were going to receive, let's say, if we are having 100,000 receipts, it means we are now going to use a larger spot rate of 1.2743, which will give us very few. If the base amount was, if the base currency is pounds, it simply means that we are going to receive very few pounds. So a country with a higher inflation is expected to have its currency weaker. All right, is expected to have its currency weaker. That's the purchasing power parity theory. The interest rate parity is useful for the prediction of forward rates. So the FO is actually the forward rate, which is equal to the current spot rate, and we then use the 1 plus IC. This is the interest rate of the foreign country, all right, divided by 1 plus the interest rate of the best country. Okay, so the movement in interest rates as well has got some contribution in the determination of the future of the forward rates. All right, there is that relationship. All right, this could be short term or long term. All right, so that's the brief. You can refer to the parts of the video or the lecture series where we talked much about these issues, and I'm sure there you would be helped. All right, I also pointed out that this formula, the Fisher formula, is also useful in the computation of discount rates. Some present value or NPV computation might be silent about the discount rate, and you'll be given the real rates of inflation. I mean, the real rate of borrowing and the inflation rate. All right, and you need to then compute the nominal interest rate, which is the I. The nominal interest rate, the nominal rate would be having both the real rate and the inflation premium. You need to know that, all right? But the real rate does not have the inflation premium included. So all those things you need to work out with all these formulas to understand what would be going on. Okay, so without much ado, ladies and gentlemen, let's continue with our exercise. And problem is I'm not seeing my, okay, where are we now? Can I do some slideshow and see if we can proceed? I think you guys can understand as well that, oh, this guy is now tired. Okay, now we have talked of those theories. Now, what is the 3 months forward exchange rate to 4 decimal places, right? So we come back to the question because we've been talking and talking and talking. So if you look at the question, you can see that much work has to be done for us to compute the forward rate. Okay, we need to use, which formula do you think is useful here? Obviously, if we use the interest rate parity theory, is going to help us to come up with the forward, because the interest rate parity, what's going on? I can't find my pen. I can't find my pen. It means, okay, the interest rate parity theory says that FO is equal to SO multiplied by 1 plus IC over 1 plus IB. And we have the spot rate. Okay, we have the spot rate, we have the annual rates, but these annual rates have to be adjusted to 3 months, 3 months tenure, right? So that's the adjustments. For example, the foreign country here is the US, okay, the IC, that's the IC rate, and this one, that's the IC, the IB rate, all right? And the spot rate is given as this one, our SO. So if you slot in those figures, I'm sure you are going to be in the right direction. Okay, as you can see there. All right, we use the spot rate, and we also have to adjust for 3 months. Also here we adjust for 3 months. And we then come to, just ignore this 0, it's not there, it's a typo. And you can see that the forward is an inflated rate. Why? Because the inflation for the foreign country, is 3.3 against 2.9. Right, so obviously the forward rate is going to increase. Are we together, ladies and gentlemen? These are the tricky, juicy situations in this particular examination. Okay, let us do this one more question. One risk that a company that exports faces is that of exchange losses when accounting results of its foreign branches or subsidiaries are converted into home currency. What is the name usually given to this type of risk? You can pause the video and try this on your own. Okay, good. Here we are talking of losses which are subject to accounting practices, or losses which are reported by accounting records or as a result of accounting conventions, accounting translations, and so forth. So they are record-keeping losses. They have nothing to do with the cash flows. So in that case, this is translation risk. Now, part E. Why is a currency option a particularly suitable device to reduce exposure to currency movements when tendering for a contract priced in a foreign currency? Okay, you then have to have some understanding of currency options. Right? We haven't touched that part yet, but you need, in the examination, you'll be tested on your understanding of these options. Remember, I pointed out that these are also part of external hedging techniques. Although you're not going to be expected to do some computations related to these techniques, you need to have some background information about them. You need to discuss them in an examination, otherwise you're going to fail. And the examiner is not going to be lenient to you just because you do not know the figures. It doesn't mean that you do not know the theory. Is that clear, ladies and gentlemen? Good. So Why is a currency option a particularly suitable device to reduce exposure to currency movements when tendering for a contract priced in a foreign currency? All right, so the situation or the scenario is talking about a situation where you want to go for a contract which is in a foreign country, or it is being priced in foreign currency. Okay, so they are saying, why are currency options better instruments in hedging those transactions? A, cheapest means of achieving a hedge. Is it really true that they are cheap? That's not the case. They are actually expensive because you need to pay some premium to, for that flexibility, because an option can only be exercised if it is convenient to you, if it is putting you at an advantage. So there is an option premium that is payable. Least risky means of achieving a hedge against what? A risk against what? It's not really an answer I am comfortable with, but I just continue with the choices. Least unfavorable effect in the published accounts. Well, although we have to worry about published accounts, but in wealth maximization, please, this issue of published accounts and so forth doesn't really have to be something to use as a weapon. So that answer is least considerate. We need to it's something that is a red herring, something out of context, and should be put aside. Right? So it seems like all the options there are getting wayward. What about option D? You may not get the contract and therefore the currency. Okay, I feel that has got something to do with the option flexibility. Okay, remember, you are bidding for a foreign contract. It's not yet yours. All right. So if you don't get the contract, therefore you do not get the currency, therefore you just ignore. Okay, you just don't exercise anything, you just ignore. So by the end of the day, the answer on part D is actually something that is linked to the scenario. It's not just a book answer, it's something that is linked to the scenario in question. Right? That's my thinking. Okay, I don't know what the examiner was thinking. So obviously my thoughts were correct. You may not get the contract and therefore the currency. Let us hear the explanations. All right. A currency option provides the right but not obligation to buy or sell a currency at a specified rate on or before a certain date. This is particularly suitable when tendering for a contract priced in a foreign currency because there is uncertainty about whether the contract will be won. If the contract is not awarded, the company can simply let the option expire, avoiding unnecessary currency transactions. This flexibility makes options ideal for hedging uncertain exposures. So you can see that we were almost near, because in the examination it's all about having the good idea, the basic idea. Not you in the examination. We cannot expect you to have to have all this mouthful of words, all this demagogy, pedantics. You're not expected to produce such type of high profile English or language, but have them some business reasoning. You need to reason like a business financial manager. So why are the other options not the correct options? Number one, cheapest means of achieving a hedge. Options are generally more expensive than other hedging tools like forward contracts because of the premium paid for the right without obligation. Therefore, this is incorrect. 2. Least risk means of achieving a hedge. Other options limit downside risk. They do not eliminate it entirely, as the premium paid is already a sunk cost. Additionally, forward contracts provide certainty without the premium cost, so this statement is misleading. Lastly, least unfavorable effect in the published accounts. The cost of the premium can impact financial statements, and unrealized gains or losses might also be reported depending on accounting standards. Other hedging methods, such as forwards, can be more straightforward in terms of accounting impact. Is that clear, ladies and gentlemen? I think for now, please allow me to have some rest. I'll continue with this video series so that you guys continue to learn. We want to master risk management. Remember, we are still in current